So what happened is you have what's called a secondary market. That they created an unlimited supply of funds to buy real estate. Secondary market expands to provide even more funds for home loans. And you see the initials? AIG took your insurance money that was supposed to be to be invested safely for your life insurance policy and became a secondary lender in the mortgage market to provide higher yields. So they could show Wall Street that they're a really good, big giant company. Well, that's a $70 billion mistake that we're having to pay for now. Does it make you angry yet? Okay. You have a home buyer, and where they go to is what's called the primary market. All right. The primary market is like this credit union or a bank or anybody that's loaning money is a primary market. The secondary market is where they go. Okay, so you'll never talk to a secondary market person. But we as real estate people, and especially lenders, deal with it all day long. Okay? So what happens in the secondary market will affect your interest rates tomorrow, and the next day, and the next day. And that affects how much your payment is, which affects me as a realtor when you call up and go, rates went up 0.25%. I go, yeah, that's like $80 a month, isn't it? Or they call up and say, the market's gone down. All right, saved you $80 a month. Okay. Anyways, the home buyer goes to the credit union, which is the primary market. The primary market writes a loan, does their underwriting, gives the money to the buyer so he can go buy his house. This paper gets packaged up with a bunch of other loans and gets sold over to the secondary market. They've loaned their money out, right, so they don't have it anymore, but then they sell their paper over here, okay, and then the money comes back to the credit union or to the banks so that there's more money to lend to the next person that comes along, okay? And so this secondary market included Fannie Mae and Freddie Mac, okay? And that was a pretty good model for a long, long time, for decades. It was a great model. In fact, Fannie Mae, I think, Good to Great, one of those nice books written by Tom Collins, or whatever, wrote a good book on making great. He actually talked about Fannie Mae as being such this great company. And I was listening to the books on tape, and I thought, I wonder what he said now. But that was back in the 80s. Okay, so this is a secondary market. Okay, this was actually quasi-funded by the federal government. That's supposed to be a Capitol there, Capitol building. Okay, so it's partially owned by the federal government or backed, and certainly enough, we knew that if it got really bad, the government would bail them out. So actually, then what would prevent you from writing risky loans? Keep the profits going. Keep the profits going. Right? Keep those bonuses going. Okay. So, the secondary market here. But we created a whole bunch of other secondary markets chasing after those high yields. And I won't pick on AIG, but we will anyways. Okay, you got AIG, you got insurance companies. Anybody that had money that wanted high yields, that did it right, could package up mortgage-backed securities and then sell them to Wall Street and sell them worldwide. Well, it all goes back to that house, or those houses, or those thousands of houses, or those hundreds of thousands of houses that back these loans, and these credit borrowers who might not have been prepared for what is going to happen. Okay, so what happens? Buyer stops making payments because he can't afford it because it reset too high. Buyer says, I didn't have good credit to begin with, so why don't you go ahead and give your house back? He gives the house back, moves into an apartment. This house now becomes we're going to talk about foreclosures later on, becomes a non-performing asset. And you multiply that by thousands of times, and all of a sudden you see collapse of that market. And you see the federal government coming in and bailing out Fannie Mae and Freddie Mac. That's what happened. That's what happened. It all went back to, what do we call Joe the Plumber? We won't pick on Joe the Plumber. It all went back to he should have got a loan in the first place. Yeah. Yes.
I heard you say that those were packaged and sold worldwide. So is this a huge attribution to the world economy that's struggling right now? Just our subprime issue?
They're mortgage-backed securities is what they were, okay? And that's what they call mortgage-backed securities, which also compete with treasury bonds for supposedly safe investments, okay? And so, yes, there were a lot of companies worldwide that were sold a bill of goods that these mortgages or mortgage-backed securities were safe investments. Okay, that is why all of the investment bankers on Wall Street are gone. Think about it, right? Shearson's gone, Merrill Lynch is gone. They're all gobbled up. They're gone. They're all owned by banks now. Is there any? I mean, maybe Schwab, but I don't think they're on Wall Street. But you know what I'm saying? They're all gone. All that big Wall Street, because and it was all going back to greed. Once again, it's greed. They were making their bonuses. They were providing a lot of people with good living. So, yeah, it's a national, international crisis, but it's not an opportunity to freak out. It happens. It happened in 1980s with the RTC, Resolution Trust Corporation. Big giant savings and loans. We're doing the same thing with commercial properties and lending with no basis of why they should have been paid back. And so we ended up as the federal government, as owners of the federal government, ended up paying billions of dollars to bail the Resolution Trust Company. Now, what it did do, it gave people opportunities of a lifetime, and companies opportunities of a lifetime to buy real estate at 10 cents on the dollar. Do you remember Austin, Texas, 1987? You could buy a house in Millwood for 20 grand. Okay, so it costs us a lot, but you know what? You should benefit by saying, okay, well, the opportunity is, let me go buy a piece of property. It's like, you see gas prices go up, well, you should own stock in a gas company. Be glad that the prices went up. I don't know. I'm not an expert on gas, but I'm definitely an expert on real estate. So in the early 2000s, real estate was driven up by speculation, not by supply and demand, which happened in the RTC back in those days. Higher risk loans were more available because it was a model. And as the values continued to be driven up, and appraisers kept on saying that, the values are there, the values are there. Higher risk loans became more available. Even no income, no asset loans began to appear. Hey, you don't have to show us any income, you don't have to show us any assets, here's the money. That. As us in the industry were saying, that's crazy. And I talked to an old car guy who's going to be my partner in a commercial deal, and he said he used to do car notes. He said, what? No income, no asset. What were they thinking? Okay, but it became the norm. It became normal.